is going to give us some interesting ideas or alternatives of how we can make sure we have a transparent system. The floor is yours, Thierry.
Thank you, Chairwoman McCarthy. It's a great honor to be here today. Finance Watch is grateful to the Econ Committee for asking the question of how to restore integrity and trust in the wake of the Libor scandal. Financial activity consists by nature of exchanging promises, and what is a promise worth if you do not trust the person making it? The reality today is that public trust in the fairness of financial activities has been profoundly shaken. Libor and Euribor have different definitions, which makes the possibility of rate rigging different. But they have one feature in common. They are calculated from contributions with inbuilt conflicts of interest, and this characteristic is not compatible with the ambition of rebuilding integrity and trust in our financial system. In the 7 minutes I've been given to make this statement, I will highlight 4 simple measures which, taken together, would establish integrity and trust post-Libor, Euribor. The first measure is subjecting to public control financial activities with public interest implications. The banks contributing to Libor and Euribor trade books of financial instruments, such as interest rate swaps, whose value is linked to those benchmarks, and those banks' own cost of funding is by definition linked to those benchmarks. This means that contributing different figures for Libor or Euribor can mean more or less profits for bank. The conflict of interest is obvious. Libor, Euribor, but also commodity and credit indices have a large impact on public interest. As a consequence, we think that their contributions and their calculation process should be controlled by supervisors and not by private organizations, particularly in the context of conflicts of interest just described. Moreover, the supervisor in charge should have as little proximity as possible with contributors and should have an international mandate in order to ensure that the control is exercised in a neutral and non-complacent manner. The second measure is establishing consistency between benchmarks used for similar purposes. As already stated, Libor and Euribor have different definitions. This reflects the fact that they were established by different private bodies pursuing different and often competing interests. Libor is meant to reflect the cost of borrowing of the bank contributing, whilst Euribor is meant to reflect the contributing bank's conviction about the cost at which a prime bank, that is not necessarily the contributing bank itself, would offer term deposits to another prime bank. Today, US dollar Libor has 18 contributing banks, and Euro Euribor has 44. It could be argued that Libor's definition is more demanding, but on the other hand, it could also be argued that having a broader base of contributors makes Euribor less prone to manipulation. These differences only make the debate more difficult to follow and, in turn, feed an ever-increasing mistrust of financial activities. This is all the more worrying as those benchmarks are not only massively used by professionals, but also as a reference for many retail financial products, ranging from money market funds to mortgage loans. There is an important consumer protection dimension to this debate. Finance Watch welcomes the task forces that have been put together by BIS and IOSCO and hopes that the question of the consistency of definitions across benchmarks will be addressed in their respective works. The third measure is basing benchmarks on effective rates. In the world of finance, prices that do not reflect transactions have very little, if any, economic meaning. Basing Libor and Euribor on effective rates would make contributions reflect a financial reality by definition and would make cheating more difficult. Provided an evolution of the benchmark's definition is adopted, basing Libor and Euribor setting on real transactions is technically feasible. Basing Libor and Euribor setting on real transactions is therefore not only possible, but is also the most effective way of ensuring that contributions to those benchmarks reflect the true cost of banks' liquidity. The fourth measure is making banks, operators, and managers responsible for their actions. Banks should be held responsible, and supervisors should have the power to impose sanctions commensurate with the damage caused. As long as the profits derived from cheating are greater than the potential penalties, there will be an incentive for banks to cheat, and the trust of the greater public will not be re-established. It is also fundamental that operators should be held personally responsible for their actions, and as is currently discussed in the market abuse debate. As importantly, bank managers should also be held personally responsible for the actions of the operators reporting to them, as manipulations can only result either from complicity between managers and operators or from managers grossly neglecting their duty of controlling operators. As a conclusion, I will say that no financial system and indeed no economic system can exist without trust and integrity. Legislators and regulators have a responsibility to take the measures necessary to avoid a repetition of events feeding, once again, a widespread and profoundly detrimental anti-bank sentiment in society. We are confident that adopting the four simple measures that we propose, not only for benchmarks such as Libor or Euribor, but also for commodity and credit-related benchmarks where similar issues are encountered, will contribute to establishing integrity and therefore trust in financial activities. Finally, I would like to emphasize our conviction that no solution based on self-regulation will be up to this ambition, as self-regulation has proven over and over again to be an oxymoron when it comes to financial services. Thank you very much.
Okay.